Hello, I'm Deborah Trowell of Elevation Financial Group, and this is the September Market Update. My guest today is Jonathan Bowman. He's with American Century Investments. John has worked with them for 25 years, and he is a portfolio manager for the Sustainable Equity Fund. John is based in Kansas City, and of course, he's a big Chiefs fan. I do need to, before we continue our conversation, put up a disclosure slide. So if we could have that, please. Thank you very much. So welcome, John.
Well, thank you, Deborah. It's great to be here. As you mentioned, I'm a Chiefs fan, a little bit of a nail biter last night, but glad to see them pull through and get the win. But yeah, thanks for the opportunity to speak to you today.
Yeah, well, great. Well, today we are talking about the markets, but we're also talking about them with regards to sustainable or ESG investing. So let's start by having you, John, just give us an overview of where we're at this point in the year.
Sure. So, it's actually been, as I'm sure many of you are aware, a bit of a rocky year from a market perspective. I think that's really been driven by sort of a domino effect of different events, really. And part of that was initially the signs that we're seeing of inflation in the market and higher prices that consumers are paying today. And that really, in our view, was a function of the imbalances of the demand for goods that we saw consumers really see a sharp increase in coming out of COVID, right? We were all stuck at home with time on our hands to shop online, and we looked around our house and realized maybe there were some things that needed improving or some new furniture that we needed. And so you had a really big increase in demand, really helped by that. And the economy still being reasonably strong as we bounce back from COVID. But on top of that, you also had constrained supply, right? The availability of goods was impacted by COVID, and therefore it was tougher to get those things. And the result, when you have an imbalance between high demand and low supply, is higher prices, right? And so if we've seen prices increase, what has happened is the Federal Reserve and other central banks around the world have tried to cool the economy by raising interest rates. And that sharp increase that we've seen in interest rates has really impacted stock prices this year. If you think about the value of owning a stock whose returns come at some point in the future, if interest rates are higher, now that trade-off between returns that may come at some point in the future versus higher cash you could get now in your investments, very safe, stable investments, is now different, and that's really had an impact on equities. And really what we're seeing more recently is some signs that maybe the economy is going to cool, which I think is the expectation to try to help bring inflation under control. But that's led to some additional volatility in the stock market.
Yeah, and we just had a new inflation report this week, didn't we?
We did, yeah. And so what that report showed us is that while maybe there are some signs that the highest of highs of inflation that we've seen in the most recent months is perhaps cooling, it's still running hotter than the market would like to see at this point in time. And so the expectation is the Federal Reserve is going to have to continue to be pretty aggressive in trying to cool the inflationary impacts we're seeing. And you're starting to see some other signs of cooling, whether it's companies that now say they have too much inventory, right? So didn't have enough inventory when the economy recovered and everyone was buying stuff. Now people, if they bought new furniture, they don't need to buy new furniture again. And so you're seeing signs that some of that inventory is leading to discounting. We've heard retailers like Walmart and Target. Just yesterday, I saw an article about a company that makes fertilizer, Scotts Miracle-Gro, basically having way too much fertilizer, right? Because they overbuilt for what they thought was going to be a continued strength and growth. So I think those are signs that we may start to see lower inflationary readings going forward. We've seen fuel prices come down, for example, but it doesn't look like we're out of the woods yet. And that's the reason the Fed is going to have to continue to stay diligent and likely continue down their path of raising interest rates to try to cool that inflation down.
Yeah, and of course the markets don't like that. So thanks for telling us about what's driving the markets now. One thing that's happened since my last market presentation is the passing of the Inflation Reduction Act. Can you tell us what that means for the economy?
Yeah, well, as the name implies, I really don't think it's likely to reduce inflation much, at least in the near term. Essentially what the Inflation Reduction Act is a recycling of some of the provisions that were in the original Build Back Better bill. So different components, things like a minimum 15% tax on large corporations, hiring more IRS agents to enforce tax laws, negotiating drug prices and putting caps on out-of-pocket drug spending for Medicare, and then importantly, some additional incentives for renewable energy. And economists disagree on how deflationary these provisions will ultimately be, and you could even argue that some may actually add to inflationary pressure. So, for example, companies may raise prices to help offset the higher taxes they now have to pay. Consumers may spend the money that they're actually saving now with prescriptions being lower on other goods, right, that also have supply constraints. And then some of the incentives for renewables may actually drive the price of some of those products up, at least in the near term. An example was Ford hiked the price of one of their electric vehicles by $8,000 a couple of days after the $7,500 tax credit incentive passed, right? So you're potentially shifting some of that savings at the consumer level back to the companies themselves as they push those incentives along. So, I think at the end of the day, from a marketing and political standpoint, it was something the government really tried to bring a focus to. Obviously, inflation is top of mind for everybody these days, and if you hear somebody passes the Inflation Reduction Act, that sounds better than passing something like a Green New Deal or Build Back Better, which people maybe don't quite agree with at a headline perspective. And maybe longer term, as we have lower energy costs because of some of the renewables, lower drug prices in general, I think are a good thing, right? That immediately reduces spending that consumers have. Those things may be good, but I do think it's, in my opinion, a little bit more of a marketing name than it is, in fact, truly an inflationary reduction type of act.
Yes, and it's so interesting when politics, of course, is always intertwined with economics, even where we don't want it to be. But when we talk about the environmental part of that bill, you're managing this sustainable equity fund. So I imagine you're really interested in those provisions. Tell us a bit about how you are approaching your stock selection process for your fund.
Yeah, so obviously, as the name implies, with sustainable equity, our goal really is to identify companies that we think over time are going to be more sustainable. But I'd say what's a bit different from our approach, maybe relative to others that you may be familiar with, is we don't exclude anything right off the bat. What we're really looking for across all sectors are companies that we think have attractive traditional financial metrics. So we're looking for high quality companies with improving cash flows and margins. But alongside that, they do a better job than other companies within their sector of managing what we think are material risks that can relate to environmental, social, or governance issues. And so what that often does then is lead us to names that do benefit from some of these themes, such as renewable energy. And so I'll give you an example of one of our holdings, which is a utility company called NextEra Energy. It's one of the largest developers and operators of renewable energy generation, and relative to other utility companies that we could invest in that still depend on a high degree of coal generation for their electricity, and maybe don't have as strong of operational benefits as NextEra, that they are just less attractive to us, and we avoid those. Maybe another example, we have exposure to industrial gas companies like an Air Products within the material sector that is actually one of the key beneficiaries of this Inflation Reduction Act, as there's a lot of incentives there to drive down the cost of green hydrogen. And so hydrogen's a gas that's used, and has been used in lots of places for lots of decades. But what green hydrogen does is allow you to produce that hydrogen in a much more environmentally friendly way. And essentially the cost gap between green hydrogen and what we call gray hydrogen, which is historically used, much more, or I should say less sustainable inputs, has now become almost on par. And so, those companies that are making that transition to more green hydrogen, we think are going to be some of the beneficiaries of that Inflation Reduction Act that we just discussed.
Yeah, and it's so interesting to hear you talking about how things are evolving and changing all the time. And I know that one thing in my conversations with clients, they'll ask about, well, what is in the fund and what isn't in the fund. They're very interested, of course, to see what companies you choose to be part of this sustainable fund. And you actually have some companies that are more traditional that we might not expect to be a holding. So can you say a little bit more about that?
Yeah, so and I think that's really one of the key differences of what we call an integrated ESG approach versus an exclusionary one. So, as I mentioned, we look across all sectors. So even a sector like energy, for example, which some of the more exclusionary approaches out there may just say we're just not going to invest in energy at all. And what we've decided instead is let's identify companies within that sector that we think are actually taking the right steps to manage through a energy transition that's going to take place over a period of time. It's not going to happen today, right? We still depend on fossil fuels pretty heavily through our economy. You can't just turn that off overnight. But there's also a recognition that there is going to be this transition over time, and let's identify the companies that we think are positioned well to navigate that, while also recognizing that they can reduce as much as possible their carbon footprint. And by investing in those companies, not only do we think they're going to be rewarded over time financially relative to other companies within their sector, but it also gives us a seat at the table to engage with them and have ongoing conversations about the policies and procedures and steps they're taking. Whereas if you're not invested in the companies at all, you don't have a seat at the table, right? You don't have a voice. And so, if you think of a sector like energy, we can still find companies that fit our process. And an example of that would be Schlumberger, which is an oil services company. They have one of the smallest carbon footprints within the entire energy sector. They've actually established net zero climate goals for 2050, which they're the first oil services company to do that. And that includes what we call Scope 3 emissions, which is just a fancy term for all the emissions of everything that goes into their process, not just from the generation of oil and gas. So that would include even their customers. And then ultimately, they've also created a division focused on that energy transition and solutions for that. So it's around things like geothermal, hydrogen, which we talked about, carbon capture. And then if we look at, from a financial perspective, they're also seeing very strong improvement in growth in the financial components of their business as a result of the type of work that they do. They've got a global footprint, and we're seeing really strong demand for solutions within the energy space in light of what's gone on this year with Russia's invasion of Ukraine and the impact that's had on the availability of energy in other parts of the world.
Yeah, I think what's happened in Germany, for example, where they would like to have just said, we don't want to use Russian oil anymore. We have a great demonstration of how it's just not possible to turn off that spigot and immediately turn to an alternative, that these things have to happen much more slowly and over time.
For sure. Yeah.
Mm-hmm. Yeah. So let's switch gears a little bit. There's another big question that my clients always have on mind, and that is, and hopefully you have your crystal ball ready here. Do you think that we're in recession or going into recession?
Yeah, no, that's a great question. I'd say probably the short answer is maybe. So maybe my crystal ball is a bit cloudy, but I think you've got a couple competing arguments for, are we in recession or are we not in recession? I think it's what oftentimes gets referred to in the media is if you have 2 quarters in a row of negative GDP or economic growth, then that means that we are in a recession. And by that definition, we're already there, right? The last 2 quarters, we've seen slightly negative economic growth. But on the flip side, consumer spending has remained really strong. It's kind of surprisingly strong, candidly, in many cases. I think part of that is consumers still have some pent up savings that they were able to put off to the side during COVID when they weren't traveling and doing things and maybe spending as much as they otherwise would. And so that's allowed the consumer to be a little bit more resilient than they otherwise would have been. And generally, people still have jobs, right? We have unemployment rate at one of the lowest levels we've seen. And not only that, people with jobs are finding, because the market is tight and there's a scarcity, if you will, of available workers in some sectors and industries, that's actually led to some increases in wages, which kind of gets back to our whole inflation conversation that we talked about earlier. But all those things have really kind of, I think, provided a bit of a buffer, if you will, in a period where we would expect the economy to be a little bit softer. So if the National Bureau of Economic Research, NBER, if they're sort of the official arbiters of recession, if they ultimately, and they of course do this with the benefit of hindsight, but if they ultimately 6 months, 9 months from now come out and say, yes, we do have a recessionary period here, it's likely going to be more a function of continued softening on the consumer side. The consumer makes up about 70% of the economy. And so if the impact of higher food and fuel prices and all those sorts of things really impact the consumer dramatically, where they just can't spend as much going forward, then I think that could ultimately lead to that definition, if you will, of a recession. That being said, we've had recessions in the past. Some are pretty shallow and you come out of them pretty quickly. Others maybe persist a little bit longer. And I think the real driver there, and sort of the wild card in all of this, is what happens with corporate earnings. We've seen so far companies have been able to continue to grow their earnings. The expectation is that while things are going to slow, there's still enough demand for earnings growth there. But we're also starting to see some cracks show up. Just today, FedEx, which I'm sure everyone is familiar with what they do, obviously a global delivery company, they reported pretty soft numbers and give a pretty gloomy outlook. And I mean, again, they have a global business. I think a lot of that's being driven by Europe and parts of Asia, where there's still COVID restrictions that are impacting kind of the flow of goods there. But definitely, potentially a bit of a canary in the coal mine, if you will, on softer earnings ahead if some of these headwinds that we've seen more recently continue. So kind of a non-answer answer to you there, unfortunately, Deborah, but I'd say odds are probably more likely that we may see a recessionary definition, but it in our view, there's still enough good things going on that it likely won't be a deep one or a protracted one.
Well, that's really good to hear. Obviously, we don't know until it happens, but keeping a positive outlook is helpful as well, I know. And I'm definitely seeing that clients are still taking trips and doing things that they weren't able to do in COVID. So I agree with you that continuation of spending and having resources to do that is definitely holding things up at the moment. So the next thing that we're going to see happen is, of course, we have our elections coming right up in November, and everyone always thinks that that's going to have a big impact on the market. So does it or doesn't it?
Yeah, I think it's interesting to talk about, and you're right. It's one of those things that, first of all, if my crystal ball on the economy is not very good, my crystal ball on politics is even worse. But ultimately, what we've seen historically is, even when there's been pretty big shifts in who has control of the House and the Senate versus who has control of the presidency, oftentimes what happens is the impact is either slow or non-existent. And markets may move a little bit in anticipation. I think back to kind of the last time you had a lot of control in the House and Senate, beyond the current environment right now, right, where you have the Democrats sit on the presidency of the House and the Senate. It took them all the way till now to get kind of a skinny down version of this Inflation Reduction Act bill put through. It's not like it's an instant, all of a sudden everything changes, right? And similarly, under the last administration, we saw control of the presidency of the House and the Senate. There was this expectation that it was going to be this big boon for energy companies, and that was exactly the opposite is what happened, right? So long story short, I think the market tries to get ahead of itself and anticipate what may happen, but in reality, the wheels of government move very slowly and the impacts are pretty minimal. And generally, historically, if you look, the market actually kind of likes it when there's gridlock. The sort of old adage is gridlock is good. And what that means is if there's gridlock, let's say it's a Democrat-controlled presidency and a Republican-controlled House and Senate, especially if there's not, a huge majority in either of those halls of Congress. Not a whole lot gets done, and the market's usually okay with that, right? If there's not much change, then people can kind of predict the future perhaps a little bit more consistently and understand how companies will operate, and therefore the impact is pretty minimal. And so I think, if you read kind of the current news, it sounds like the Democrats may lose the House, it may lose the Senate, although that's debatable. It seems like things are really close. But if that happens and you end up with gridlock, that generally historically has been pretty good for the markets.
Yeah, so it kind of settles things down a little bit, and and obviously we all know that removing uncertainty is also good for tamping down that volatility a bit, isn't it? I mean, you're still looking at companies based on how they're going to make money, right? Not, well, obviously they will be impacted by some political decisions, but mostly, are they still continuing to do good business?
Yeah, exactly.
Yeah. All right. Well, thanks so much, John. That's some very great commentary for us. Anything that you'd like to wrap up with as some final comments?
Yeah, I mean, I think the last thing I'd like to say is, it can be easy to get caught up in the short-term noise and volatility in the markets, as you've said, Deborah. But as investors, it's important to have a plan and stick to it. Just like ourselves, we believe in the long-term trends that are driving the companies that we're investing in. We want to understand the long-term risks that those companies are facing, and the daily noise and movements of the market have very little to do with that. And so similarly, as you think about your own investing plans, working with an advisor like Deborah can help you stay on course to achieve those long-term goals.
Well, thanks, John. We appreciate this great information. We'll wrap up for today. We hope everyone's found this helpful. If you have a question related to this, please don't hesitate to email, give a call at the office. Always happy to talk to you about your investments, and we can speak with you directly. My next Elevation Market Update will be recorded in November and sent out and posted from there. Thank you very much, and goodbye for today.